Well, thanks for joining us. I'm Marlin Bohling with you as we watch your ag commodity trade. In fact, let's go ahead and take a look at our grain trade right now and get you updated on our current prices. Let's take a look at that corn market first of all in Chicago, where we have the March corn now a penny higher at $3.57.5, and you have the May a penny higher at $3.66 even per bushel. So it's about as we opened up in the initial trades here. We have the soybean trade today on that March contract. If we can roll over to the soybeans here we have the March now 9 3/4 higher at $9.95 1/4, and you have your July 9 1/2 higher at $10.16 this morning. Now, what about the wheat trade this morning? A lot more talk about continuing dryness in the plains, and it seems to be supporting the wheat. We have March Chicago wheat up 6 1/2 at $4.47.5. July new crop up 6 1/4. Kansas City, we have the March contract there, now trading 7 1/2 higher. And the last trade, $4.50.5 per bushel. July up 7 1/4 at $4.81 3/4. Let's switch to the Minneapolis wheat trade, where we have the March now 2 3/4 higher at $6.17 1/4, and July up 3 1/4 at $6.34. Cotton market this morning, we have the March contract now down 99 at $79.49 per pound, and July down 100 points, and it's trading at 80.72. The new crop December down 38 at 75.13. Here joining us in studio, we have Mr. Chris Swift.
Good morning, Marlin.
How you doing?
Doing great.
Swift Trading in Nashville. All right. A firmer tone on the grain markets this morning.
Yes, very nice to see for what's coming in on a Monday morning.
What are you looking at, and what do you attribute that to here?
Well, I think the dry weather is. The Palmer Drought Index showed increasing areas still of the drought and now growing in intensity. So it kind of puts people's minds. And then Informa came out last week and said they might see a few acres reduced. I would imagine as loans are being restructured for the year, you'll begin to see which is going to be the more profitable crop. Right now, with beans carrying some premium to them, they look like they could pencil in the black margins, and corn probably still in the red in a lot of areas unless we breach above $4.
Yeah, the wheat, we've talked about that for a week or two now, that some analysts wondered if maybe that couldn't be what they call a dark horse candidate in the grain trade here,
yeah,
where it had been overlooked, but it may have a lot of potential.
Yes, it very well could. Wheat got beat up pretty bad with the world wheat supplies, but once you start taking into them and where you have a very weak U.S. dollar, that begins to promote that much more export business, and it doesn't take long to start dwindling those stocks down when you know that there's not as much coming from the forward.
On the cotton trade, a lot of weakness today. Now it got up over 84 for a little while here, about a week ago or so, and then it immediately had a reversal, sold off after that, and it hasn't really looked back ever since. Right now we're at 79.53, the way it looks. The new crop's still over 75 cents, 75.13 on that December contract. So the spread continues to really narrow up, another 60 points or so here today. Is that still justification for guys to be looking at new crop cotton versus these other crops yet?
Well, it's possible with cotton, such a smaller area that you can grow that cotton in, and most of the cotton now is grown under irrigation. So I don't know that it will rob too many acres from soybeans, which would be the primary ground that it would rob acres from. So I don't think that increase in the December contract would be enough just yet to start robbing acres away from others. Okay.
On the corn and soybean trade, do you think there's much spread trading going on between those two at the present time or not?
There could be. There's probably not a lot right now. As we get closer into planting season, that spread will grow rapidly. But right now, I think it's more people just trying to come up out of their shorts and make sure that they're not hung at the very low end of this market with sales.
Funds are still heavily net short on, especially on corn and wheat,
yes,
right?
That is correct.
Okay, all right, so that could be a factor. All right, Chris, we're going to come back in just a moment. We are talking with Chris Swift of Swift Trading. We're going to come back and analyze what's going on in the livestock trade. I know from talking with Chris before we came on, he has some real thoughts on this cattle on feed report. He'll have some detailed information when we come back. Back with you, we're talking with Chris Swift of Swift Trading in Nashville. He joins us on the set in studio right now. All right, Chris, I have to ask you about this cattle on feed report that came out last Friday, and we can put those numbers up for everybody at home in case they missed them from Friday afternoon. We had the on-feed number coming out at, I believe it was 103%. We had the, or 108%, I'm sorry. We had the placements at 101%. Now that was a little over 4 points higher than the average trade guess. And then the marketings came in at 99%, and that was about as expected. Now, the placements number was higher than expected. However, you say there is a real certain way to read that, that you have to look into the fine print of that placements number and figure out why it is that we have the markets opening higher on the nearby contracts on cattle, maybe not on deferreds. You say that you have to bury or dig into the numbers a little bit here and find all that info. What's going on?
Well, on the on-feed number, it came out pretty much as anticipated. 107.7 was the trade guess and came out at 108. You had one less marketing day in December 2017, so were you to add that day, you would have actually had over a 100% marketing in that time frame. But the on-feed number was interesting. You placed very few feeder cattle. You placed a great deal of stocker cattle, but you didn't place a great deal of feeder cattle. So running at about 156 to 160 days on feed right now, that puts you a little bit short of inventory coming into the May-June time frame.
So you say the placements number could really have an impact here on the deferred contracts especially.
Absolutely. It pushes a lot of fat cattle down into the summer months, since we had October and November showed pretty much the same things, elevated lower placements, so it takes a little bit longer for those cattle to grow. They will probably be out in the July through September time frame. And now that we see even in the month of December for the placements, they also have more lightweight animals in there, so that'll push them further on down the road as well.
So the placements number, even though it was higher, it was kind of bunched in one particular weight group.
Exactly, exactly. They were 8% higher. The under 600 category was 8% higher, and all the other categories of elevated weight were all less than previous year.
Interesting stuff. So thanks for pointing that out. Let's take a look at where we now stand. All right. Let's go to the big board and take a look at our Chicago prices here. On Chicago live cattle, we have February up $1.40. We're at 126 even per hundredweight, and we have the April contract now 90 higher at 125.58. So just like you said, we are leading with the nearby contracts. The deferred contracts you were speaking about are only about 30, 35 higher. On the feeder cattle trade, let's switch over there. And here we have the March leading the way. It's $1.20 higher. 147.92 is our last trade, but it's only about 20 cents from our low of the day. That's interesting. It is off of its high by about $1.50 already. April up 98, now up 90 at 148.12. Let's switch over to the lean hog trade, and on the lean hogs this morning we have the February 60 higher, but all the other months a little bit weaker. We have April down 15 now at 73.65. Tell me, Chris, here, is the hog market content to be a follower today, or is there more at work on the chart?
You know, probably hogs are going to weaken just a little bit here. We noticed that in December you had elevated production again. It was one of the record pork productions. So although there's no demand decrease in it whatsoever, we are increasing the production of hogs at a pretty rapid pace. So it's probably just not bull market environment right now for the hogs.
All right. Thank you, Chris, for coming in. Good to talk with you again.
Absolutely, always, Mark.
Have a great trading weekend.
Thank you, sir.
All right, Chris Swift with Swift Trading in Nashville. Christina, back to you.
Always appreciate your analysis, Chris. Thanks for joining us today. And thank you, Marlin, of course.